in order to be willing to invest in the company. Obviously, this test precludes the completely legitimate field of venture capital and entrepreneurial startup type situations. There's nothing wrong with those approaches to investment. It's just not what we could do in the context of the portfolio at Markell.
At Markell, our fundamental financial goal is to compound book value at a high rate and over a long period of time. This measurement, growth in book value per share over a long term, really does incorporate our total return, and it closely represents long-term return on shareholders' equity. Since our initial public offering in 1986, we've compounded book value per share at an annual compound rate of approximately 20%. Clearly, we do not guarantee such results forever into the future, but the financial model of having an insurance business that generates consistent underwriting profits, along with an investment model where we invest the funds intelligently, enable this to occur. Our combination of underwriting results and excellent investment returns are generating these returns. Our underwriters focus on specialty niches where our knowledge and expertise enable us to excel. The insurance market can be both competitive and it's often cyclical. So having a disciplined underwriting approach is absolutely critical. There are times in the marketplace that it's necessary to simply back off. Our incentive compensation plans are closely align our performance with our results. Our underwriters share in the underwriting results of their businesses, and our senior managers focus on long-term compounding of book value per share. Throughout this process, we account conservatively to minimize surprises and to honestly and fully report our results. I think it's also important to point out that we earn these returns without excessive financial leverage. For our business, we believe that having approximately 1/3 debt and 2/3 equity represents a good balance. Today, our financial leverage is even less. Everyone would prefer smooth and consistent results, but generally business, and certainly the insurance business, does not lend itself to smooth and consistent. We know hurricanes will happen, just not exactly when. Because the business of insurance is in fact helping others generate smooth, our results are sometimes somewhat lumpy. And the same applies to our investment returns. But for Markell, we are okay with this sort of short-term uncertainty. But we're very, very disciplined to look for and expect to earn solid returns over the long term. And we typically measure our performance in rolling 5-year blocks.
The second test I use is to attempt to do my best to make sure that the people running the company, your partners, have equal measures of both talent and integrity. One without the other is useless. People who possess integrity but are short talent may be very nice people. You may enjoy their social company or think highly of their willingness to coach the Little League team, but they don't have the talent to get the job done in the business. Therefore, you need to assess the talent level of the managements that are running the businesses in which you invest. Similarly, if management possesses plenty of talent but leaves something to be desired on the integrity side, they will end up making money, but you, as their outside partner, will not.
Talent and integrity are tough to measure, and you certainly should not rely on my obviously biased opinion. But you can look at what we've done and how we've done it. Patrick Henry said, "I have but one lamp by which my feet are guided, and that is the lamp of experience. I know of no way of judging the future but by the past." The Markell style defines our value system, and we clearly define our operating standards. Our compensation system is fair, rewards excellent performance, and does not misappropriate shareholder funds. We do not use and have not used stock options, yet stock ownership is and has been a very important component of building our associates' wealth. We're focused on the long term, the real economic returns of the business, rather than simple accounting numbers. Our reporting and disclosure is clear, concise, and complete, both the good news and the bad news. A key element in evaluating insurance risk is to think about moral hazards. For an example, we do not want our insurance policies to create an incentive for our insureds to have losses. Therefore, in our equine insurance division, we don't want to insure $100,000 horses for $1 million. On the contrary, we want our insureds to have their interest in their property closely aligned with ours. Many of the recent financial disasters can be connected to this principle. How many mortgage brokers and how many security syndicators had any interest whatsoever in the underlying loans or the repayment ability of the borrowers? And what did the executives of some of the larger companies that have recently gone bust have to lose when they levered their companies up 30 or 40 or 50 times? Many companies think of their shareholders as nameless institutions that mindlessly trade their shares. At Markell, our shareholders are our friends and our neighbors, our families, as well as the institutions we know and admire and respect. We ourselves are shareholders, and our associates are shareholders, and for the most part, the stock that we own, we've acquired in the marketplace. We maintain open and honest relationships with our shareholders and recognize that ultimately, they are in fact the owners of the business. Honesty and integrity are critical elements of the Markell style. As it is often said, it takes a lifetime to build a reputation and about 5 seconds to lose it.
The third thing I think about are the reinvestment dynamics of a business. The best business in the world is one that makes a good return on its capital and can reinvest at the same or better rate as time goes by. That's a compounding machine which creates great wealth over time. Time here is a concept worth hitting again. Clearly, many successful financial operators have done very well by buying businesses at attractive prices, improving their performance, and selling them for even more attractive prices. There are probably a lot of classes and people here focused on how to do that. What I'm talking about here is the rare case of something compounding year after year after year. Clearly, Berkshire Hathaway stands as the current best example of a business that did this for decades. Before Berkshire, Henry Singleton, who Buffett cites as a role model, did the same thing at Teledyne. A noted money manager in Houston, Texas, named Fayez Sarofim, was an early investor in Teledyne. People kept asking him, "What is the next Teledyne?" Sarofim was famous for responding, "The next Teledyne is Teledyne." That sort of multi-decade compounding is what I'm talking about here when I talk about the reinvestment dynamics that describe the very best kind of business. The second best kind of business is one that makes good returns on its capital, but really can't reinvest the earnings due to the nature of the market they serve. Think of a high-end restaurant where the owner works there all the time. It may be